too much debt, there are a couple of ways you can deal with that. You can try to outgrow your debt. You can, if you grow fast enough, you can carry a certain amount of debt. You can try to raise taxes, you can lower expenditure, you can restructure, do the noble thing, hey, I give up, or you can print money. And so if you look around the world, different places in the world will deal with these issues in different ways. The Europeans are trying to deal with austerity. It doesn't work particularly well. In the US, we got the Bernanke Fed, in the future the Yellen Fed. And in Japan, we got Abe. And we sometimes joke that we never had a Eurozone crisis. That's the good news. The bad news is we have a global crisis. And so we're going to have policymakers that are going to be very actively engaged. And there's this myth here that the US has the cleanest of the dirty shirts, and therefore you want to have your money in the US. I don't know how many of you are aware that year to date, the best performing major currency is the euro. Last year with this mess in Europe, the euro outperformed the dollar, was up 1.76% versus the dollar. So the cleanest shirt is not always the best performing one. Just like Apple is a great company, but you can lose money investing in Apple as well. In 2008, the yen was the best performing currency. That was the safe haven where you wanted to have your money. But if you do a check of whether the yen is still a safe haven, you can do that. If you do a rolling correlation of the yen and the VIX index, you'll see that that correlation is gradually eroding. And it happens to be eroding in parallel with the erosion of the current account deficit. Now in plain English, it means that once you need to finance yourself with money from foreigners, deficits will start to matter.
I want to put out the idea that what we have today is inflation and deflation at the same time. People say, well, how can that be the case? So what you have is this natural deflation from the Depression, offset by inflation caused by policy. They're pushing against each other, and just like the San Andreas Fault, that does not mean it's stable. It's unstable. It's going to snap, but you don't know which way. We could snap into inflation and then into something like higher inflation very quickly. And I think that's a serious possibility. But we could tip into deflation as well. We could have both. We could have a deflationary episode followed by inflation. You can have growth in a depression, but it's a sustained long period of below trend growth. It's the anemic growth that defines the depression. So if normal growth in the United States is say 3 to 4%, that's kind of our potential. Sometimes it's higher, and growth is 1 or 2%. That's a depression. You still have growth. But what's happening is there's sort of a 4%, potential growth curve. There's a 1 or 2% actual growth curve. That gap between the two is getting bigger and bigger. You never recover it. You might get back to trend eventually, but you never make up that loss. That's what a depression is. Tip the bartender, and the bartender takes a taxi cab home, and the taxi cab driver puts some gas in his car. That dollar had velocity of 3, because $1 supported $3 of goods and services. The tip, the taxi ride, and the gasoline. But if I stay home and watch TV and don't spend money, my money has velocity of 0. The Fed is printing the money, but we're not spending it. The banks aren't lending. We're not borrowing. We're not spending. The money's sitting in the bank, or sitting in gold, or sitting in real estate, but it's not turning over. And I like to remind people, go back to this equation, $3 trillion times 0 is 0. If you don't have velocity, you don't have an economy. The economy goes to 0. It's worse than anything you can imagine. You cut taxes, they're probably going to deleverage. They're probably going to pay off student loans, pay off car loans, credit cards, mortgages, second mortgages, whatever. Just because you put money in people's pockets doesn't mean they spend it. So we may be stuck in this liquidity trap for a long time.
What's the policy publication to follow today?
If you set up a Twitter feed so that you've got Wall Street Journal, Financial Times, Economist, New York Times, if you told me I could have the Twitter, not the tweets I put out, but the ones I read, you said I could have that or I could have Bloomberg, I'd rather have Twitter.
If or when this collapse happens and you have a certain percentage of your portfolio in, say, gold, is it better to have it in your physical possession here or to have it stored somewhere overseas?
The Swiss have been changing their rules on bank secrecy on a dramatic scale. And you just don't know what's going to happen. The Swiss bankruptcy has more holes than the Swiss cheese has. So if there's money to be had, the government is going to be somewhere near you and is going to try to put its hands on it. And so you might as well structure it in a way that the government is not going to have a problem with it, but at the same time have some sort of escape hatch that you're comfortable with.
I mean, if you want to get into disaster scenarios, that's the what I call the 30 years war portfolio, gold, art, and land.